Good morning. This is Ken Long at Tortoise Capital with a review of the weekend trading report for October 1st, 2017. Market remains in bullish, quiet conditions with volatility at a historic low. On an annual basis, using NDX 260, the market is overbought at 102, meaning there was a breakout to a 12-month high. That's what you get from the number being greater than 100. 10-day NDX for the short-term market condition at 131. Market is overbought, and there was a breakout on Friday going into the close. In the market mosaic, price with respect to the 200-day moving average is green bullish, 5.19%. Slope of the 50 is yellow bearish at 0.16. ADX is a weekly trending 12.4. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the boundary between risk on and risk off. The current reading is at 1.12, so we are into risk on conditions. We take that score, compare it to the last 5,000 trading days, and find the average and the standard deviation, and we compute the z-score of that risk index, which we call the risk z, and that's at 1.26, meaning it's 1.26 standard deviations above the long-term average. And you see here a 90-day histogram of that indicator. The increasing oscillations of that index have been favoring some swing trades lately. The index reading is above the zero line and greater than 1, and so this was a warning on the slight decline to be prepared for volatility spikes to the downside, but the resumption here suggests there may be an additional leg up. So this has been a really nice long side swing trade where this indicator went down to -2 sigma, and then this entire length has been excellent for long-term swings. It featured a 15% move in the XIV symbol, which we have been managing that swing trade as we go. This little hook up right here suggests there may be another leg up. Because it's already so far from the zero line, however, I'm prepared for a shortened time horizon, and I'm ready for intraday indications of system shocks, and so I'm ready to supplement or hedge the swing positions with some intraday trading, so some core and turbo in effect. Longer term systems, these are going to be the holdings for the month of November, for the month of October, with our next reevaluation due on or about 1 November. It's Latin America, emerging markets, and U.S. small caps in ETF 13. ETF 22, it's Latin America, emerging markets, and U.S. technology. In ETF 32, it's Brazil, Latin America, and then the BRIC countries, which also includes a heap of Latin America and Brazil. And so that should tell you that the relative strength trends in Latin America and Brazil are worth playing on a shorter term basis. If there is a monthly performance advantage there, then that should also reflect an outperformance in the same direction on a weekly basis, which makes that a good swing trade candidate. Or if we're near the end of that move, a reversion back to long-term performance means suggests that a reversion to the mean trade is possible in the shorter time horizon. So this alert gives us opportunities to participate in many different time frames. In ETF2, the theoretical exposure is at 100% still. Just a quick look at some of the ETF portfolios for blended monthly rebalancing. You see a little pullback here in Latin America, and this is what I'm talking about. The 1 week underperformance and the 1 month underperformance is either a signal for an end to this outperformance on the longer term, so it may be a reversion to the mean, or it may be the pause that refreshes and allows for to buy a quality region on sale. So I'm framing the trade in both directions, and at the same time I'm looking for some emergent strength to continue in the U.S. small caps with 1 week and 1 month performances that are excellent, along with MDY, which has been the most underperforming sector in the global markets, has also turned in a nice 1 week and 1 month move. So this could be a resumption here in the U.S. For the last 6 months, the globals have been outperforming the U.S., but this may be an indication of potential reversal of fortunes. In ETF 32, you're seeing the same kinds of issues. Here's XLF has been turning in some good performance. The small caps, energy sector, and the U.S. mid caps. What's been giving up some of the gains are the longer term winners like Brazil, Latin America, the BRICS, China. This is a new one. This is the ETF sector spiders. And what I've done here is this is kind of a hybrid approach where I'm taking a combination of the U.S. symbols in the sector spiders, an expanded version of those, and looking at all the business sectors that the sector spiders reflect. So you'll see the traditional 9XL series like technology and finance, but now an expanded and more detailed version that includes more narrowly defined sectors like biotech and aerospace. I'm trying to get a little more fidelity inside the sector plays. This acts not only as a set of tradables if we're looking at asset allocation rotation in the U.S., but also an indication of market conditions on the basis of business sectors, so we can see how money rotates among sectors or if the market itself is being powerful. And I think you can see here these top 5 or 6 are really where the strength has been, and some of the defensive plays starting to give up some gains here, like in utilities, real estate, and treasuries are now suffering at the hands of the more aggressive growth areas. So if we combine this insight with the risk C, then we are prepared to continue to play swing trades and position trades to the upside in the leading candidates. Now, oil and gas is an area where you can see the turnaround in the shorter time frames. Longer term, it has underperformed on 6 months. You can see it's down 11% from where it was 6 months ago. But the last 3 months have been an outperforming 11.5%, and then the 1 month and the 1 week performances are in the green. So relative to the other sectors, oil and gas equipment have been making a strong turnaround. So by paying attention to these 1 week and 1 month, we are getting a way to see the outperformance that ends up getting reflected in 3 and 6 month performances, which makes their blended performance excellent, which makes them candidates for the longer term momentum holding systems. And so this is like an early turnaround report. And so this looks attractive here in oil and gas. So XES should definitely be on our short-term radar for both day trading and for swing trading. So that's how we're using this report. In ETF Max, this is the same thing, only now we're looking at a broader set of ETFs to cover the world market model. And now you can see that there have been some serious pullbacks in Brazil, Brazil consumer, China materials, but where the strength has been is like in semiconductors, S&P biotech, as well as metals, rare earth and strategic metals. The big sell-off there in Brazil suggests to me a repositioning of institutional money that might be just cashing in that excellent performance, looking to normalize their portfolios. And so that doesn't put the outperformance at risk, but it does create an opportunity to frame that trade in either direction. At the end of this video, we'll take a look at Brazil and Latin America in order to see what that looks like. In the world health check here, the world market health check, this is the S&P's health check, I should say. The vertical blue lines are 10, 20, and 30 days worth of look back, 40, 50, and 60. 30 and 60 are the big blue lines. Just so we can kind of get a sense of the 10-day chunks. This sine wave is the slope of the 30-period regression line, which I take to be the health of the trend. and the red dots are where they were at where that was at local minimums. The blue dot is where it crossed the zero line and where that slope actually went negative. And then the green dots are the areas when that 30 period slope was at its peak. And you'll notice here that the current reading is at the black dot, and so we're above the zero line, so that's healthy. This is what that 30 period regression line looks like. That slope is so steep that it's up here almost at 0.32. If that were to get to 0.4, this would be abnormally steep, but we're the strength of this leg here, the steepness of that slope is better than it achieved in either of the previous two upswings, and so this has more strength rather than less strength. And you see that reflected in the dragon has left the river, and there was a positive breakout. This breakout above the 10-day high is also above the annual high, so this is a breakout to all-time new highs going into a weekend, and that has to be considered a favorable interpretation of the market right there. Market has been oversold for most of the last 30 days, and each of the three little dips, have been replied to with a resumption of strength of trend. You notice that the PPO, which is like a MACD histogram, the crossover to the upside occurred here, so this was a good signal to get long inside that green circle. The same way this one was a good signal to get long when that crossover occurred to the upside. When it closes like that, that suggests, hey, this is the pause that may signal the end of that trend. You'll notice that at that point, the steepness of the 30 was as steep as it was in the two previous excursions. Each of those was followed by a sell-off, and you notice that the sell-off here was abbreviated, just touched the edge of the river, found support, and continued. So in terms of price interpretation, we see this as a, if this is the first leg up, pause, second leg up, pause, start of a third leg, this would be an extraordinary move altogether. So if we get another 3 to 5 days of upside, then the steepness of that 30 would be pronounced. This would be a remarkable 30-day outperformance here, and this goes in line with the a recent report in, I want to say, Bloomberg, that showed the last 30 days have been among the, I think, has been the least volatile September in history. So going into the fall, this is certainly a market that is extended but is cautiously optimistic, and so we'll continue to frame trades in both directions. Now, these red lines represent resistance levels, which are now support levels, and if this market does collapse, then these become the price ladders for targets on the way down. If that were to happen, and then that red line gets violated, that's a place to add a position, add a position, add a position, and then the big collapse. I want you to notice that the 200 period moving average is no longer even on the chart here, and that's how strong this move up has been. So more room to the upside. The downside targets of significance right here around looks like 248-ish, 246, and then 242 on the downside, the bottom of the river. So optimistic about this in the longer term. ETF2 regional report. All 10 indexes are on a buy signal compared to their 4-month moving average, which puts the asset allocation model still at 100% invested, 0% cash. We're in a bull quiet market. EFA 50 is stronger than the S&P at 46, so it's still the global stronger than the S&P, but I think when we looked at those ETF portfolios, we're seeing a beginning of a rotation back to the U.S. and some belief in the economy there. Oops, excuse me. U.S. indexes, it's U.S. technology at 50, followed by the S&P, and small caps at 46, followed by mid caps at 43. The two strongest sectors remain emerging markets in Latin America, two weakest small caps and mid caps. But I think that is getting ready to change. Now, inside the S&P sector, spiders, weakness in energy, although we are seeing the beginnings of a turnaround there. And strength is in 51 here, the U.S. technology. World market model, U.S., the large caps are above average, everything else below average with the exception of that blended small cap. Strength in China and most of the Asians. All of the Europeans strong. The other asset classes giving up some of their advantages, with the exception of private equity. And then Latin America, emerging markets, and the rest of the Western Hemisphere all above average. So you can see only the U.S. has that lingering weakness, except Indonesia and Australia. It's still the globals, but I think we're early in the stages of perhaps a U.S. recovery, so I'll be prepared to reward that. ETF Top 30 uses a slightly different lens. It's the ETF2 database, but this is a different frame of reference, but the findings are the same because they're all based essentially on price and momentum. Emerging strength in biotech is reinforced here. Home construction, giving up some of the strength here, white and green, giving up the strength in the European top 50s for large caps. Continuous strength here, and everything that is green and green has been an enduring winner. The ones that are white and green are the ones that are giving up some of that strength, like Europe, Germany, South Korea, Spain, Europe. So again, we're starting to see a rotation back to the U.S. Average daily dollar volume plus the relative volatility gives us targets for excellent swing trades that are both volatile and liquid. So the VIX, EFA, Brazil, oil and gas exploration, all of these are very tradable intraday because of the combination of volatility and liquidity. Shifting to the daily report now. Plenty in the auto framer to choose from, and some key leaders here in the 551W. Brazil, Latin America, emerging markets. This is the case where it's up over the last 5 weeks, down over the last 5 days, and a positive white candle on Friday. And since these were key leaders before but have suffered in the last couple weeks, and then gave us a positive one-day gain, this is almost a poor man's triple screen, where we're seeing perhaps a resumption of the longer-term primary trend. So that makes them very interesting and attractive on that basis. Among the large caps, seeing some of the key leaders in the Dow firing on channeling and overreaction and washout, as well as in 3M on the 55W. You can see again some of where those signals come from, and the auto framer reward to risk ratios, a number of good frog quality numbers built in, and some RSI2 signals indicating perhaps a 2-day washout. So Walmart, as an example, is a 3 on an RSI2. It was a big percent loser, down 1% on Friday. It tests out at 2.2 to 1 on the auto framer as a retest of the 10-day high, and fired on both channeling and overreaction. So that makes it a nice and interesting target. In the ETF 30, plenty to choose from here on the auto framer and on the frog quality numbers, and you can see the pain in the volatility ETF and the gains available in XIV over a 1-month period. This thing is up over 20%, and this corresponds with that powerful swing move in the S&P over the last 30 days. Has been reflected in XIV, which is strongly correlated to S&P, but more like a 5 times leveraged S&P. So it makes it a terrific trading candidate for short-term and intraday trading. In the daily pinch and stretch, there are 4 categories I look at. The first 2 take a look at where the price is compared to the river. So these are the price standouts where price is stretched a distance above its own 30-period moving average, which is the center of the river. So energy, small caps, ExxonMobil, Home Depot, Intel, that's consistent with the fact that those sectors that they are from have been outperforming. So this means that XLE at 5.75% above its moving average that's a 1.51 stretch above. So that's been an exceptional move. And so that postures it for either a continued leg up or a significant reversion back to the mean offers a 5.75% price move on the downside without violating the strength of that move. Same thing with small caps. The most negative Z stretches then are those, it's the same idea but in the other direction. These are the ones that are most stretched below their river. So Procter & Gamble is minus 1.88% below its 30-day moving average, and that's a minus 1.4 Z score. So it's between the edge of the river and the floodplain, right in the middle. So I look at these as ones where continued failure is an auto short, because whatever caused it to fail that much is continuing and it's out of the river and failing. Or a resumption to the upside suggests that a return to the 30-day moving average is not out of the question, and then you can see the size of that move. In general, what we're seeing with the big stretches above is typical of a bullish market where the stretches to the upside are greater than the stretches to the downside. I place the U.S. indexes in here just as a point of reference, so you can see what the broader market itself is doing. Now, the third and the fourth columns have to do with the width of the river itself. When the river is very wide, the most expanded pinch box then, these are the cases in green where the width of the river is abnormally wide. So Pfizer and Home Depot, the river is wide, and that comes from a sustained directional move to the either to the upside or the downside over the last 30 days. In order to make that river very wide, there had to have been an exceptionally large stretch, and so that's one where we can say that the sustained move is worthy of attention. Similarly, these that are highlighted in the red are exceptionally narrow, the most compressed pinch boxes, and I especially like these because they are potential breakouts in either direction. This is the beginning qualities of a Z3 pinch box, and so Walmart is nice because we saw that potentially has a frameable trade in both directions, and the river is abnormally pinched. So Walmart and U.S. real estate and Verizon are on the short list of interest. Now, the super pinches, there's an additional factor. These are ones where the Z-score of the width of the river is narrowly compressed, and the four regression lines that we care about have been very tightly compressed. So this is a case where the short, medium, and long-term price valuations of different time frames have all agreed on what fair price is. So when you combine a consensus about fair value and a very narrowly compressed price range indicated by an abnormally compressed river, then what you have are the conditions for a Z3 pinch breakout in either direction. So these become high priorities for a move in either direction. Later in the video and in the chat room, we'll cover the trade frames for that specifically for subscribers. But this is how we use the pinch and stretch report to find our candidates for swing and intraday breakouts. In the auto framer, we have here the mechanically computed reward to risk ratios on a retest of the 10-day high, and then what those key trade framing numbers are. We use this to develop our trading plan for swing trades. Regression line fractal framework, these are the ones where price has moved a significant number of ATRs above or below its own RL270, and this gives us a way to frame swing trades in a powerful way for these different categories of symbols. The ones that are in the green are the most ATRs below their own long-term fair value, and the ones in the bottom shelf in the red, these are the ones that are overheated. These have been the relative strength leaders. These are the ones that are the most ATR above their own RL270, and you can see we got Chevron and ExxonMobil. That's an indication of the recent power of the energy sector move, and why that as a sector, not only just individual companies, but as a sector, why that's of interest to us. Daily squeezes are ones in which we have a combination of a very narrowly compressed range on the previous day and an expansive range stat, which gives us the possibility for one-day pops, that if a price breaks out of yesterday's trading range between yesterday's high and low, then there's a possibility for an outsized one-day move as a jump out of that compressed one-day trading range. And so these are one-day poppers, if you will. And then you can see all the trade stats for framing those trades. VIX, Amazon, mid caps, small caps, Morgan Stanley, CBS, all of these are of interest to us. Market mosaic, there's the slope of the 30-period moving average. The polynomial regression line shows a little bit of weakening of that large, strong move based on those last 3 days or 4 days of sell-off. But more to the upside is still possible. This is the slope of that regression line plotted against its own 10-period moving average. When it makes a crossover like it did here, more than one standard deviation away from the long-term average, this signals a potential turning point. And you'll notice that that here, instead of failing, it had some strength and moved out. So we're getting an alert in this area that the upside move is possible, and that was a move from 246 to 251. And this indicator has been very helpful in plotting those intermediate turning points in market conditions. You can see it on a 180-day basis. Here, it's now stretched above its long-term Z1 score, and so this is now becoming potentially overheated and an abnormally good move, which we've already discussed before. It can get very good, like it did here, but when it crosses over, again, more than one SD outside of the long-term average, these moments signal important turning points in the market. We had one here as well. And then if the market were to roll over here at some point, this 2 or 3 days of continued weakness would trigger a belief that it was the end of this long run that you see here. So cautiously optimistic, and the money that we've made on swings inside here are things that I'm interested in preserving. Although I'm open to the possibility of no resistance overhead, the only thing that limits the market here is imagination. This gives you the 10-year long-term view of that 30-period regression slope, and you can see where we are here, just moving above the 1 SD point. We're already starting to get into rarefied atmosphere, and notice how sharply those extreme slopes up revert when they do collapse, and so that's why we're careful on both sides. A longer-term measure of volatility here, finding an extremely quiet market, and historically quiet over the last 180 days. So I'm going to be aware of the possibility for volatility spikes. The 30 has come out of its Z-score river. The 90 is not overheated. This is just a powerful move that's grinding along higher lows and starting this new leg as the river begins to expand. And that's everything I want to cover from the weekend report. Plenty to think about. I'll do a separate video for the trade frames that I've talked about in here for our subscribers, and place those trade frames in the chat room to help us develop our swing trades. So that's a look at our strategy report and some ideas for the week ahead. Keep your risk measured and your powder dry.